Thank you, Marina. And welcome and thank you everyone for joining us today. Good morning and good afternoon to wherever you are. As Marina said, we're excited to host this panel regarding investing in healthcare real estate. We'll shortly pass it over to the panelists to introduce themselves, but a lot of changes happening in the marketplace, accelerated by the pandemic. There's been a lot of growth within this particular sector of the real estate space. So we're excited to have a few experts today to kind of speak to the different sectors that they are playing in and speak to the markets and welcome any questions. We want to make this panel as conversational and dynamic as possible and are excited to kind of kick it off. So I'll give a quick background of myself. As Marina said, my name is Vanessa Gill. I work at Bridge Investment Group. Bridge Investment Group, for those who don't know, is a $26 billion real estate investment firm. We invest across the real estate space in multifamily, workforce and affordable housing, suburban prime office, seniors housing, logistics, commercial real estate backed fixed income and opportunity zones, and primarily investing within the kind of high growth secondary markets within the US. So with that, I'll pass it over to Dan to kick off. Introductions, it'd be helpful to just give a quick background on yourselves, your firm, sector focus, and maybe where you're based. I'm today based in New York City, where we have one of our offices.
Thanks, Vanessa. Yes, my name is Daniel Nagler. I'm Executive Vice President of Capital Markets at Cabot & Forbes. We are a real estate development firm based in Boston, Massachusetts. We were founded in 1904. We had a national focus for some time, but then eventually we were pretty much only focused in the greater Boston area. We are primarily a developer. We develop regular commercial office buildings historically and industrial office parks. In the more recent iteration of our firm, we've been doing a lot more multifamily and life science development. And currently in our life science kind of healthcare real estate vertical, we're seeing that about 1 million square feet of new development that we have in our pipeline, and we have about 17 acres in Cambridge, and we have some other sites that are outside the city as the field has been expanded.
Thank you, Dan. Maybe Matt next.
Sure, thanks. So I'm Matt Withy, Managing Director. I'm with Virtus Real Estate Capital. Contrary to what my headshot was just saying, I do work for a real company, not Healthcare West Acquisitions Corporation. But I oversee all of our healthcare acquisitions. We are a private equity firm, invests exclusively in recession resilient real estate asset classes. We have about $1 billion in total assets under management, and within healthcare, that encompasses for us medical office, senior living, life science, and other specialty use healthcare product types. In addition to healthcare, we're active in workforce housing, education related real estate, and self-storage as well.
Thanks, Matt. And Gary, to round it off.
Good morning, everybody. Gary Werner. I'm a managing director with Next Tier HD. We are a mission critical investor, and by definition, mission critical for us has always meant something that has historically had a raised floor environment and uptime needs. We have broadened that definition in recent years to include the likes of medical and life sciences. Our platform is nationwide. We tend to be focused around what we call the eds and meds of the world. Many of our opportunities that we invest in are relationship driven, and we tend to reposition assets. So we'll find something that may have been neglected but has an interesting story around it. And from there, we build our relationships. We've done some work with Georgia Tech, Princeton University, Carnegie Mellon University. Many of those are focus on the more high-tech research side of things, doing high-performance computing centers and supercomputers. But we've found those relationships have taken us down the rabbit hole into other areas of their needs. So the evolution into healthcare and life science is a natural flow for us.
That's great. Thank you, Gary, for that. So maybe to kick it off, I mean, it's a good segue into talking through, and maybe Dan, you can kick this off for us, but it'd be helpful, you know, there's some obvious drivers that we can understand as we think about how the healthcare real estate industry has certainly grown. I mean, the pandemic being the most obvious of those, but it'd be helpful to hear from you all as it relates to, you know, you spoke about some of the sectors that you're specifically focused in, life sciences, seniors housing, and kind of opportunistic plays, but some of the demand drivers that are kind of driving where you're investing from a market's perspective, and also some of the opportunities that you're seeking specifically within some of these sectors within the healthcare space.
Certainly. Yeah. I mean, in Boston, I think you could look at this as kind of a microcosm of other kind of top markets, San Francisco, New York, et cetera. You know, one of the larger things that we've seen as a new development is the growth of CGMP manufacturing. So basically, we're seeing a lot of firms that are doing their own drug manufacturing, and part of that vertical integration that they're moving into has been in part for, you know, we look at kind of like 4 different reasons for that. Usually it's been done with contract manufacturers in different markets. But as, you know, the technology has become more sophisticated, you know, better gene therapies and more investment into it. So kind of the things that we're seeing, at least in this one field, is, you know, that there's an importance to protect your IP, which is, you know, intellectual property, the accessibility to the R&D facilities, the speed to market. Part of that is, you know, the CMOs are pretty much backed up, you know, the contract manufacturers. And so there's a need to sort of take control of your own drug manufacturing, and just general industry acceleration. You know, the amount of new therapies that are being developed in phase 2 and phase 3 trials has just accelerated the need to get the drug therapies out there. And some of this was related to COVID. You know, and a good example of this has been, you know, Moderna, who's based in Cambridge, and, you know, they have headquarters is in, in Kendall Square, but they had to expand their GMP manufacturing base, which was based in Norwood, which is outside the city, from 300,000 square feet to 650,000 square feet recently. And that's just one example. It's just a part of the market we just never saw before, you know, maybe a year ago. Now, there were some groups that were doing it, but just the acceleration of this one field has really expanded, you know, suburban development that we've seen.
Got it. That's super helpful. And maybe before I turn it over to someone else, I guess, Dan, on that front, how do you see that, you know, there's a lot of growth that's surged, as you just said, in the last year, specific to life sciences and specific to the market that you're in. How do you see that expanding in the coming kind of 5-10 years? And from a markets perspective, while Boston and Cambridge may be your expertise, are there other markets that you think are kind of key for that overall ecosystem?
Yeah, I mean, again, I think, you know, the amount of capital investment into life sciences is driving this. I mean, we're seeing record venture capital funding, NIH funding, you know, links to university systems. There's a record amount of employment. So all this is fulfilling the need for, you know, the demand for space. And, you know, what we're noticing in Boston is that even though we have about another 5 to 6 million of new development in the pipeline, that's going to be delivered in 2022 and 2023, you know, a portion of that, you know, of that 5 to 6 million, 3 million of it is already spoken for and pre-leased. And there's still a demand of about, you know, 4 to 5 million of space. We're in an imbalance of supply and demand. And when you're doing that, we're noticing that we're seeing conversions of offices. So in some regards, it's been good for our real estate market because it's showing that, okay, office has been hurt, traditional office, so people are looking at ways to convert over those spaces into some type of lab setting. Industrial has been converted over for CGMP. And then, you know, we're seeing things move out into the suburbs. And we saw, for instance, markets that just really wouldn't have generated the rents that justify the development, but we're seeing it now in, you know, kind of suburbs of like Watertown, Somerville, even as you get more outside the city. And part of that is just there's no release valve. We're looking at rents that are escalating from, I think it was a year ago, the average rent in Cambridge was $75, and now it's $105. And that's not going to slow anytime soon, because that's still the premier market if you're going to be a top life science company. But the smaller ones that are in phase 1, phase 2 trials that need to expand as they're getting more VC, they have to expand somewhere where they can afford it. And so we're just kind of in this imbalance. So it's a good problem to have. But I don't think we're at any point now where we're going to see a lack of demand, and we just have to continue to develop in these markets.
Got it. That's super helpful, Dan. Maybe shifting to Matt to opine on this, and maybe speaking to kind of life sciences, but also some of the expertise you have within the broader medical office space and seniors housing, and how you've seen this kind of flow through those sectors.
Yeah, well, and I'll reiterate a couple things too that Dan said. I mean, admittedly, GMP space was not really on our radar. I would say, a year ago even. Just in the last, we did a big lease with a cell manufacturer down in Houston for GMP space. And that's initially what put it on our radar. They have since expanded with us twice. This is in the last 2 years. And we also have another project now underway where we're developing a building, a headquarters building in the upper Midwest for a drug delivery company that has a significant portion of GMP space as well. That's their primary research lab and manufacturing facility. So it's definitely a growing area that we're seeing. We're pretty interested in it. We're not huge players in that arena, but we're seeing activity there as well, which I think is interesting. And then even on the life science side, I mean, the growth is clearly tremendous. It's a space we've been trying to get into more. We've been more active on the traditional clinical medical office side. But we're starting to see a blend of the two products even together somewhat. The large lease that we did with the GMP space tenant down in Houston, the buildings that we owned were two buildings that were adjacent to a large regional medical center that are clinical multi-tenant medical office buildings, actually. And so, that was a surprise to us in a way to see a tenant like that really want to be in that location. I think they're somewhat unique. Most of the other, clearly there's a lot more activity in the San Diegos and Cambridges and Bay areas of the world that just have a lot more life science tenancy in them. But I think you're starting, that this tenant in particular wanted to be in that location. And I do think you'll probably see some more of that.
Great, thanks, Matt. And then I know you mentioned that you guys also invest, that Virtus does stuff in the seniors housing space. How have you seen kind of growth and changes? And I know, Gary, we'll get to you in a bit on some of this, but how have you seen the seniors housing space? There's this concept of the aging population, the silver tsunami, and you have these other factors around COVID, and how has this kind of impacted how you're investing within this space and where you're seeing kind of demand supply imbalances taking place? And I guess too, from a markets perspective, I know I think you're based in Austin, just to get a sense of the Texas markets and then kind of the general central region.
Sure. So we've historically been very active in senior. We became a lot less active 2 to 3 years ago in the senior living space. We recognized a lot of supply that was coming in the pipeline, and challenges on the labor side, quite frankly. And I think that senior living has been a very challenging industry for the past 18 months through the pandemic here. And it has a long way to go in its recovery. And we have a large portfolio, and we're working through that, and several of our assets are doing great, and other ones are struggling more, frankly. But I think long term, we really believe on the demand side for senior living. I mean, it has the same demographic trends that support everything that we're investing in on the healthcare side, and that hasn't changed. But I think that there's very depressed occupancy across the industry right now. There's significant challenges on the labor side with wage growth. And so where we see opportunity in senior living today is to stay away from product types where you have more exposure on the labor side, to stay away from the product types that have seen significant supply growth over the last few years, that have the most depressed occupancy, that also, and that tends to be the higher acuity senior living product types. Those also have the highest resident turnover. So, we see opportunity today in active adult and independent living. There's deal volume has dried up in the senior living space, but is starting to come back. And the fundamentals in the industry have, we believe, hit a bottom and are trending upward now. So there's a lot of reasons to be optimistic, and we're pretty excited about the opportunities that can present in that space. But there's significant challenges as well, and we recognize that. So we're treading carefully there. As it relates to Texas, I mean, we've been big believers in Texas. We invest across the country, and only a very small portion of our portfolio is in the Texas markets here. But just seeing the growth in each of these markets, it's been tremendous. I mean, Austin has been out of control here, and we think that continues. So, we're always looking for other ways to invest close to home. So, but we target markets across the country.
Got it. Thanks, Matt. Yeah, I mean, Austin's been a huge booming market, as I think we've all seen. But on the seniors housing stuff, we agree. We definitely saw the seniors housing sector take quite a hit from an occupancy perspective. But as you mentioned, just given the demographics that drive the kind of underlying opportunity, it really still exists. To your point, the deal flow, and I think the numbers were in 2020, I think it was about 12 billion of transaction activity, 2019 versus 2020, where it dropped by 50%. But I think we're starting to kind of see that tick back up. And certainly there are opportunities to take, ownership of assets where, there's mom and pop operators or developers who are looking to exit that didn't feel as well positioned to handle some of the impacts that the pandemic unfortunately brought about for that sector. So maybe shifting over to Gary, I know we covered a couple of pieces on the demand supply imbalance. We spoke about different markets. I don't know if you wanted to opine on anything there. You mentioned that you all look to invest in areas where there's a strong story to tell, strong fundamentals. Maybe you can speak to a little bit of where you all are focused and why you think there's a strong opportunity there.
Sure. And speaking of what Matt was talking about in terms of senior living, we are dealing with a number of assets, one of them specifically in Pittsburgh, in the suburbs. And in that area there, one of the key areas that they identified as really being, lack of supply of, which is, one of the areas to be mindful of. It's not just where you think the demand is, but what's the match with supply. You have a population that is aging in place, is content where they are, and they tend to stay in their houses, and the housing stock becomes derelict. So we find some really good partnerships with some of the local municipalities that are looking to incentivize the development of that sort of active adult living, not so much the acute care. So that's our experience with that asset type. We, like I said, tend to be focused on opportunities. We look for specific properties that we think have been neglected and could use some TLC or repositioning investment. As I said, we focus on mission critical assets, which usually involves a robust infrastructure. And sometimes you come across an asset where the infrastructure is there, but it really just doesn't match the type of demand that you thought it would, but it has a good use scenario. And in some of these cases, we find them to be located in areas where you're proximate to universities or healthcare systems. And it's a logical play to turn some of those into lab uses. Now, I don't pretend to be an expert on what goes on inside the lab itself, but we do know how to build the facility to support what it is that they are doing in there. So oftentimes that amounts to having really good power, really good connectivity, and the ability to support HVAC systems that are robust, and that includes not just supplying fresh air into it, but also exhausting the air. And as Dan was talking about, you're seeing a lot of conversions of existing assets, and unfortunately, in a lot of cases, you get people who are bringing to the forefront an asset that is already an office building, and they're trying to convert it to lab. And there's a real challenge with working around an existing tenancy base. The things that you need to do to turn something into a lab building, which oftentimes includes bringing in new air shafts to bring in that fresh air or that exhaust. You can't just cut a hole through an existing tenant space to provide that to the tenant that's below them. So it's a lot of engineering challenges. So a lot of what we look at tends to be buildings that may be already empty or have a way that we can work around the stacking plan, so to speak. So it's not for everybody. I think where we look at things is we know what we know and we know what we don't know. And it's easy to get into a trap where you find yourself in an asset and it isn't the solution you thought it would be, just because a broker told you that it's a great life sciences play. So we tend to spend a lot of time doing our due diligence on assets, work with teams of engineers and architects, as they do this a lot more from a technical standpoint than we do. We're in the process of meeting up various resources in terms of capital funding with the demand uses. So we rely on a good network of experts to help us through our process.
Thank you, Gary.
Just wanted to try, I think something that's interesting when we're talking about conversions is I think people look at it as a way to kind of get new life science supply in there. And to Gary's point, I think even if you have existing tenants, that's one problem. But also, even if it's a vacant building, it is a little difficult to retrofit it. I mean, there's certain requirements in order to be, a Class A life science building. You just may not be able to do like 15-inch clear heights, for lab, load capacity of 100, 100 pounds, stuff like that you just may not have in that building. And so you are seeing maybe groups that are changing their permits before they develop, and they're making some of those, so they're making less floors to sort of retrofit that way. That'll work. But some of these other buildings where it was an old mill building or it was an old office building, it was Class B and trying to convert it over, there's a limit to what you can do there. And some of them do work, but I don't think it really solves the supply issue other than true new development. And and again, you can retrofit like 3-stage power. You can retrofit maybe, like some of the other things like high capacity air handling units. Maybe you could add that to it. But it's just, you are kind of not. It's not a ideal and an efficient way to get new supply into the market. And so, it's a good thing for the real estate market because it means you need to develop new. And it's good that there is some conversions because it helps us with the issues that we're seeing in the commercial, office supply where, tenants are downsizing. And so if we take some of that supply out of the market, it's not as bad. And so we're noticing that, it's not as much of a renter's market as it should be based on some of these conversions. But again, it's not a great solution or a sustainable one.
Thanks, Dan. You bring up, both of you bring up two key pieces as you think about kind of development. And moving forward, technology has played obviously a huge role in the healthcare sector overall. As you think about kind of the innovation that's required and the evolution that you see within these different sectors, curious how kind of technology plays within that and how you see these sectors continuing to evolve, and kind of additionally, Dan, specifically since you're in the development space, how you are thinking about sustainability as you are building new inventory. You know, I think a lot of times, I'd say across the real estate space, holistically, when you think about some of the obsolete inventory that exists and what's kind of required as you think about, ESG is really important to investors. It's really important to kind of society as a whole. How do you incorporate that in this new inventory that you're kind of thinking about?
Yeah, and I imagine this may be for a lot of markets that are East Coast, West Coast, is that we have requirements that are put onto us regardless of we have it as an investment decision. There are certain things that we have to do for environmental codes, the stretch energy codes, things like that. You're even in your multifamily buildings that are requirements there. You're going to have, I know Boston and Cambridge have a lot of things related to, global warming type things. So you're going to see, floods that basically have to be built, even though you may not be next to the water, you need to be prepared in case water does come. So there's a lot of those things that go into it. It's one of those things, we'll do what the requirements are. It's hard for us to look beyond that just based on, what the cost to build is. We're in such a tight market as far as construction costs are relative to what you can get for return. And luckily the capital markets are, taking on lower yields, which allows you to develop a lot of these things. And, as long as we're in kind of that low interest rate, low cap rate market, you could still continue to develop at these record, construction costs. So there are some things, you could put in, and maybe those are long-term owners that they do put in that are beyond what are the requirements, to be, beyond, like a platinum environmental building versus, something that's maybe required where you don't have to do it as a requirement. So it's hard for me to say in that regard, but, technology is being driven by a lot of the capital investment we're seeing here, and it's being incorporated here. And so there is that synergy of, again, a lot of the public and private investment into these areas are forcing synergies that, we're seeing in our real estate, again, lab and CGMP. CGMP is one example of that. Before, they were separated, now they're together. So I think that's part of it too.
Great, thank you, Dan. Not sure if anyone else had any other commentary on kind of technology or evolution of the sectors. Gary or Matt, if you wanted to speak to anything there.
Yeah, I mean, technology is something that is affecting every type of facility right now. The Internet of Things comes to mind. So when you think about how are you going to get in your facility all of the different, the ability to access all of these sensors that are being placed all over a building. It's an expensive proposition when you think about having to, basically, run a Cat6 wire to any place that you'd wanted to communicate with the device. So the evolution of 5G is going to be something that is interesting in how it affects all of these facilities. But we all know that 5G is coming. Our internet providers and our phone providers are telling us every day that we need to get ready to get a new phone. The problem is that, like all of us right now, we're all sitting in a building and we're all talking on our cell phones. But 5G, the wave doesn't really penetrate through buildings really well. So there's going to be an interesting evolution of how buildings become connected in order to facilitate the use of 5G. The amount of sensors that are going to have to be put into place to be able to communicate with all these devices is going to be an interesting rollout. We're working with a number of groups right now that are looking at, well, we'll call them potential aggregators, where they're coming in and doing their own speccing the capital on installs in a building to put the sensors all over the place. And think about access points all over the place that you'd need to be able to get through all the different rooms in a building. it's going to be an interesting evolution. I think they end up being bought up by the large telecoms at some point when they develop their portfolios. But from a tech standpoint, that's what's on the forefront of our minds, is how do you keep these buildings connected to allow for the downstream technology to be installed.
Another, just something too, I would add. So on the, as it relates to technology, this is just one example. On the medical office side, we've been hearing now for a while that, doctors don't necessarily need as much waiting room space with apps and such to be able to move patients flow, through the clinical space without the need for a big waiting room. So we have a building down, it's in Texas here that we acquired that has, it's a lease up play. It's a very nice, it was originally built as an office building, has since been converted to medical, but we've got a lot of space to lease there. And one of the ideas we had was to, we worked with a local architect to design a very forward thinking spec suite for clinical medical office space. And it happened to be adjacent to a small patient waiting area that we built out that's an amenity really for the whole building, that all patients could use throughout the whole building. So we figured, hey, let's give this a shot. We keep hearing that makes sense for doctors, and we've built out the space. It looks great, but it is very forward thinking with a very, very tiny waiting room, and then a larger area for clinical medical offices. The feedback has been fantastic. People love it. It was, very much in line with all the designs that people are talking about. But I'll say, we have not leased it yet either. So, we'll see. It's still early days on that. But it hasn't necessarily flown off the shelf. So I think that, like a lot of things, right? Technology is going to certainly be changing everything as we move forward, but it takes time to be accepted by folks too. And being too early can, be harmful as well. I think for us, we've got nothing to lose with as much space as we have to lease in that building. And we're very, very happy that we did it. And I still very much believe in the concept, but, just an interesting example, I think, of that technology concept playing out, in real time with one of our assets.
Yeah, well, healthcare systems and the tenant bases aren't notorious for their quick action. So
right.
It might take them a little bit to get there. I have a lease that has been in draft format now for several months, and keeps hearing it's going to be a turn very soon. So hang in there.
I probably would just say that they can be very much stuck in their ways, but I think you said it much more politely.
Yeah. Well, it's an interesting tenant base for sure.
I think it's interesting. You guys bring up interesting points around just technology adoption and acceleration. I mean, for us in the seniors housing space, we certainly saw the importance of having technology to both connect our residents and families. We had like a radio recliner DJ situation where our seniors housing residents were able to act as DJs from their rooms and bring some sort of social connectivity at a time that was very isolating for residents and families. But you also saw things like telehealth really come into effect. And that's specific obviously to the healthcare sector, but we really relied on telehealth, and we're still using that. Obviously the pandemic is still kind of occurring, and there's the Delta variant and a lot of other considerations, but it's interesting to think about how adoption takes place within different sectors, and also how much the pandemic did accelerate other things. I mean, you saw a lot of cashless, a lot of trends that were kind of slow to be adopted get pushed forward because of some of the factors and pieces of the pandemic. So like the cashless payment and other things like that were quick to be adopted given some of the restrictions that were put into place. A couple of you mentioned Just to shift gears a little bit, a couple of you mentioned some of the cautions that you have to think about as you're investing into some of these sectors. Obviously, there's a lot of, and we can maybe kind of round out with this as we kind of head to the end of the panel, but it'd be interesting to kind of hear a little bit more about what you are, like what keeps you up at night around investing in some of these sectors. Well, there's a lot of growth potential and there's a lot of optimism and strong drivers that we've touched on. It'd be interesting to hear from you on where you kind of think the biggest pitfalls and risks are within each of these sectors.
Yeah, I think from our standpoint, what keeps us up at night is different with every asset. We have some assets which we are, extremely weighted on one particular tenant. So the ups and downs of what goes on with their operations is something that we need to be mindful of. You take from the healthcare standpoint, if you're tied to a health system that is diverse in terms of its background. Think about a lot of what went on in the early stages of COVID. You had the government basically telling hospitals that they need to keep their facilities empty to be able to handle, the surge. We saw hospitals that were, hundreds of beds, but they really only had 5 cars in the parking lot. That's not good for hospital cash flows, but we've also seen some of those hospitals that are tied to a larger health system that might be backed by an insurance company, and that side of the house for those users was robust. So it helped to support what would otherwise be for a traditional healthcare system or just healthcare delivery focus could have been a financial tragedy. So we're mindful of those things. And then we also get down into levels where we're looking at developing lab spaces that are very closely tied to the research community and in the university system. So from that standpoint, the type of tenant is totally different. I think Dan was touching on this, where you have groups that are being funded by VCs, and they're here today, they may be gone tomorrow. So you're making a substantial investment in something and you just don't know how long that tenant is going to last. They can grow and they can take up more space, or they could just be gone tomorrow. So 2 very different situations, but definitely things that we look at when we're underwriting.
One thing that for us and what we're seeing again with the growth of the industry is that, previously that the largest players in life science development have always been the REITs, and they had this unique model where if they lost a tenant, they could always put in a new tenant from their portfolio, and they had essentially a roster of people looking for it. And so they had this unique value add to their property holdings that they could always fill their and this is something that's typical where effectively these are startup companies in many ways, except for the large ones that have gone public, et cetera. But a lot of them are startup companies, and if they don't get their FDA approval, they need to downsize, and that's usually not an issue for the REITs because they could rapidly fill them. So as more and more independent groups get into that space, you're going to have less and less control of kind of these new tenants. Now it may rely on the brokers to do it. So that could be one issue that we'll see, is that maybe there's going to be a gap in if you do develop and you do have a tenant and somehow they bomb out and for some reason, even before you deliver, that could be something for us to consider. It's not a huge thing because a lot of times we're going to have this pre-lease before we even deliver. Most likely we'll have a buyer upon the delivery for us on our development. So a lot of those things will be negated. But it is something that, I think people need to have their eyes wide open to, is that, we don't have the same type of advantages that a REIT does that's a long-term holder. So that is one thing. And, probably the one that anyone that's in development, and especially in development in some of these markets, it's construction costs. And luckily, rents have been increasing at a rate similar to construction costs that allow us to continue to develop. Spreads are still low. So if some of those fundamentals go away, then you're looking at something that, that'll hurt the profitability. But again, I don't view life sciences as something that is as, at least in our market, as something that we're really, worried about. If I were doing traditional office, maybe I would be, because I do feel like there's potential gaps in the market that could be exposed depending on where you are in the cycle and, of that specific real estate market. Where life sciences, I just feel like we're in one of those places that there's just not, the real estate fundamentals are so strong and the market fundamentals are so strong that it doesn't make us that worried, So again, but we have our eyes wide open on the many of those issues.
Hey, Dan and Gary, I was just curious to get your opinion. One of the things we don't know what to make of quite yet on the life science side is how much of the absorption is tenants that are taking space where they anticipate future growth, where they don't necessarily need the space today, and that can potentially be, put the market in a spot of weakness if VC funding were to dry up, like you said, and then you could have more of a glut of space come overnight. But that's just something that we found very, very hard to really determine. But I'm curious to get your guys' thought on that.
Yeah, I mean, we've seen where tenants need to expand, but maybe they can't expand into a space because a lot of times we can lease 100,000 square feet. Okay, great. A lot of those companies can't do that. And so they can't be in the downtown, the Class A properties in Kendall Square. So they start looking into other spaces and maybe they can absorb that expansion because the rents are slightly cheaper. So instead of paying like $100 triple net, they're going to pay, 85 somewhere or 70 something, if they go further out. So I think that's how they're able to manage that risk of their expansion. And we've actually seen, which was unique, we've seen VC firms actually going ahead and pre-leasing a building, knowing that, hey, we have our roster of clients that are going to be needing this space, and we'd rather have control of that versus it being a real estate problem. Because the groups that are slow to getting space in the market really dampens their ability to be a successful company. And so if some reason you can't expand when you're ready to expand, it's a huge damper on that. So it's so you are seeing it again, it's great for the real estate developers and real estate holders of the market, but it is something that, again, that tenants are in a unique position where they have to sort of take these risks and make the gamble. And some of them are saying, well, we'll go outside the city. Do we worry about getting the right mix of talent if we're outside the downtown core, but we need it because we know we need additional space? So there's a lot of that, and it is more of a tenant problem that's hard to manage. So yeah, it is a unique problem to be in right now.
Yeah, where we're looking, we're seeing it from a different perspective, not necessarily people pre-leasing something and hoping to grow into it to control the space, as much as we're playing in markets that might be so tight that there is no available space, so that when something does come available, it's usually leased up by the adjacent user. Exactly what they do with that. In a lot of these situations that are more startup scenarios, it's not like taking down 100,000 square feet in advance and just hoping for the best. You might be looking at another 1,200 to 3,000 square feet of lab space to accommodate the next year's growth. What really requires the leap of faith, though, in those markets where there's no new supply, is to be the guy who comes in and builds the building effectively on spec without the user in tow, and hoping what you're hearing in the market in terms of things that might be coming out of the universities is something that's going to continue to grow to take up your supply.
Yeah, that's what we've seen as well. I mean, the supply dynamics in life science have just been so strong. The lack of availability has created some interesting dynamics, I think, but it's been excellent for real estate holders.
Mm-hmm.
On the medical side, I'll just speak to it briefly with some of the pitfalls that we see out there. I think that above market rents is one that we're always very, very careful about. We also have seen construction costs go up with it, which is primarily, for our purposes, contributing to TI costs, tenant improvement allowances. So understanding, what that's going to cost to lease space as well as for renewals. We see a lot of folks underestimate that often. And then I think just growth expectations. The fundamentals are very good within medical, but rent growth is always going to be more tepid compared to life sciences or some other areas that can have those explosive growth dynamics. You still have a huge portion of the medical office supply is controlled by some very large groups, health systems, doctor groups who are motivated to keep rents down. So I think that that's just reasonable expectations. There is another thing that folks that have been investing in it a long time are used to, but with a lot of new players in the space, I think that's just something that needs to remain front of mind.
Yeah, and you bring up an interesting point because especially as healthcare systems look to modernize their portfolios, you have that balance between needing to make an investment as well as needing to pay rent, and those two are not mutually exclusive. So no healthcare build out comes in at that office rule of thumb of $5 per square foot per year. We really don't see anything that in total dollars in a medical office comes in at under $100 per square foot. So when you do that over a 5-year lease, that translates into a net effective rent that's very low in most markets as traditional office rates go. So the users themselves, they have to understand that we're not just providing real estate, but we're providing a financing mechanism for them to build out their space. So when it comes down to those rents, which, really what you're comparing them to in terms of determining market rent, there's not much that's comparable, right? Because there's a significant TI amortization of that. So at the end of the day, it really comes back to who's your tenant and what's their credit, and whether you think they're going to be around for the term of that lease to amortize that TI.
Well, and I would add to that the reusability of those improvements as well. If they're highly reusable, that makes a lot of difference for the landlord as well. But you're exactly right.
Yeah, and it does. And then that brings one of the challenges that I see in a lot of cases right now. You have the healthcare systems, which are trying to, in some cases, bring things closer and closer together in terms of whether they're developing healthcare campuses. And, if that group doesn't succeed, the actual install may be reusable, but is there going to be somebody who can come and take over that campus and be able to make it work for their model?
Well, thank you both for those insights. So I guess maybe as we head into kind of the top of the hour, maybe I haven't seen any Q&A come through. I'm not sure if Marina has, but as I open it up for kind of Q&A from the group here, maybe as we kind of conclude, it'd be helpful just if each of you could just touch on, what you're most, some of the audience may be interested in investing in some of these spaces, maybe what you're most excited about and the outlook and trends that you're most focused on as we kind of move into the second half, or I guess are already in the second half of 2021 and into the coming year.
Sure. Well, I'm happy to go. Sure. So we think in the current environment, there's clearly, a lot to be careful about, but we're very optimistic and huge believers in all forms of healthcare real estate. I would say, especially medical office and life science, where we've been the most active. But we think there's opportunities in senior living as well. On the medical office side, so we invest out of two primary buckets, a core fund and a value add fund. And especially on the core side, medical office has proven its resiliency over the last year, yet again. And so from a fundamental standpoint, we don't see really hardly any issues on the horizon in that space. Pricing is a challenge, but we think that by leveraging unique sourcing agents and local relationships, that we can still, find very interesting deals in that space, with very compelling opportunities for long-term real estate holds. And on the value add side, it's a little bit more unique, but we see opportunities there as well. The space is very fragmented, just like senior living is, and that presents a host of opportunities as well. Life science definitely an area that we're actively targeting. The supply demand dynamics are incredible, and the growth, is certainly going to continue near term. So we're actively chasing that space as well right now. And then senior living, we think, is going to present tons of opportunities here. And we're actively looking at those. Long term, the space looks great. It's just, about finding opportunities right now and being able to navigate some of the near term challenges, I would say.
Yeah, the things that excite me and scare me are often the same things. We have, as a value add investor, a lot of what we have is empty. And I'm much more comfortable with an empty building right now than I would be with something that was completely full, and everything you own is obsolete. I'm excited about the ability to take what we have as a blank canvas and be able to change it, and be able to meet the needs of the market. Of course, what scares you about that is, are you in the right place? Did you end up there? And will that market be there? So it's an interesting time, I think, from the standpoint of being entrepreneurial. And I've always said we're probably the longest running startup show in history. We've been around for about 20 years in one way or another, the group of us. But I really feel that, if we're all sitting here talking in 12, 24 months, it's going to be some interesting transformations will work out for the better.
I think for us, in the way the market fundamentals are, we have this supply demand imbalance. It has opened up. As developers, we're always looking at where can we put new real estate, what's going to meet the demands of the market. And so when we have this supply demand imbalance, we're starting to see that new markets that we never would have imagined, opening up. And I talked earlier about, CGMP being a kind of a new field. I would say, beginning of this year, I never would have thought that, we would be looking at some of the sites that we currently had under agreement for maybe multifamily are now saying, hey, that's actually more economically profitable to be a CGMP site. And so that's exciting because we're starting to see different pieces of places where we can acquire lots of land. We proactively went into a place in West Cambridge and bought up 17 acres of land there before the market really started taking off in one area. And, part of that is we knew that there was an area that could fulfill a demand. And now we're kind of seeing, okay, that it could expand to kind of this drug manufacturing business where, now everyone's becoming more and more vertically integrated. So that's exciting that we can look even outside of the downtown core. We'd still love to do downtown core, but as there's really no space. So the idea that we can fulfill some of these new demand drivers that we're seeing in the market is exciting. And I think it's not related to healthcare, but I do think that we're going to get to a place where what used to be a multifamily site is now a lab GMP site. And when that happens, now suddenly with all these people coming in, this new supply, and you're having a rapid expansion of this biotech workforce, there's not going to be enough housing. And so you're going to have this back and forth of who's ahead right now as far as demand. And so there's going to be an interesting play if we can get enough acreage that we can sort of add in multifamily with that, because we can't grow as fast as the amount that we can to house people that are going to be the workers. And I think that's a unique thing that every one of these markets are where, real estate pricing is very expensive. So, for housing. And so, being able to fulfill those demands, if, eventually when it starts ebbing, if we get enough supply in life sciences, maybe the profitability will go down enough that you could start doing, multifamily again. And so that's exciting if we could somehow find some sites that are maybe cheaper that we could proactively get in there before the market actually turns. So some of those things are kind of fun, but real estate is such a slow moving process. It's not a liquid asset. So a lot of these things that you have as a thesis, you got to be taking a little bit of a risk on what you think is a good land site and hope that the market's there. Luckily, we're in Boston and some of these other places. We're fortunate enough that you can, even if it could have been a miss, it probably isn't going to be, because we're just in such a supply demand imbalance that you really can. The risk profile is really low. So anyway, it's very exciting this time right now.
Yeah, echo that. I mean, it certainly keeps it interesting when you're continuing to kind of think through, from a market's perspective, supply demand imbalances and how that continues to shift with migration trends, where employers are moving. And, it's all really interconnected at the end of the day. All of these behavioral shifts, more societal shifts, macro factors that really drive everything. In real estate probably is what excites us all about being in the sector and continuing to invest in a space that's while slowly changing, continually changing. So will be exciting to see how kind of the next 12 to 24 months unfolds and specifically within this sector. I'm not seeing, I'll shift to Marina to see if there are any Q&A that we can field here. The team's available obviously for questions afterwards if anything comes up, but appreciate the insights that Dan, Matt, and Gary were able to share with us today. And thank you all for joining us on this panel.
Thank you so much,
Thanks for hosting.
for your time. I think we're all good regarding Q&A questions, but again, I'm sure that everyone feels comfortable enough to send us any questions after the event. We're more than happy to collect these and respond via email within the week. Other than that, I would just love to thank everyone so much for joining us today. Thank you to the attendees. Special thank you to the speakers for spending the time with us and giving us a very good insight of the industry. Other than that, copies of this recording will be made available, and we're going to send a copy to each and everyone. And apart from that, just stay safe and healthy and have a great rest of your summer term.
Thank you.
Thank you so much.
Thank you,
Vanessa.
guys.
Thank you, Matt, Daniel, and Gary. Have a good
Thanks,
one. All.
everyone.
Thank you.
Thank you. Bye-bye.